starting. All attendees are in listen-only mode.
Welcome, everybody, to the third and final session of Conquering the Term Sheet, everything you need to know about deal terms. I'm Zach Miller here at OurCrowd. Joining me will be our professor in residence, David Stark, Startup Nation. You can see us and follow us there on Twitter. This is the third and final installment of a three-part series that we're doing. It's a new format for us. This is actually part of our Teach-In Tuesday webinar series. We're doing them on Wednesdays. But we're also doing a 30-minute as opposed to an hour session. We've done three different episodes on the topic of term sheets. David is going to wow you. David's going to take you through this episode through convertible notes. Our first two sessions focused on equity. Just before I hand the controls over to David, OurCrowd, if you're not familiar, is a leading equity crowdfunding platform with over 8,000 investors from over 100 companies. We invest in a lot of startups, primarily based out of Israel, but we are global in nature, and term sheets are very much part of what we do on a daily basis. Some of our investors and members of our community have asked questions. We thought this would be a great opportunity to elucidate you guys on how we view term sheets and how we think of them. So, Dave, I'm going to turn it over to David. He's going to talk about what we did the past two sessions and then take it forward with the third. David?
Thanks, Zach. So first, just to review what we covered in the first 2 weeks. As Zach mentioned, the first 2 weeks we discussed equity term sheets. Lesson 1, we talked about valuation, liquidation preferences, and ESOP. The key takeaway there was that all of these concepts are interconnected, and you really need to look at all of the terms in order to understand the full picture. In Lesson 2 last week, we discussed pro-rata rights, anti-dilution protection, various control provisions. We touched on board representation, and other related issues. And the key takeaway there was really focused on the importance of pro rata rights, how you need to have the opportunity to continue to back your winners. This is the key to success in this investment category, is understanding that there's going to be a few outliers that really drive all of your returns, and you want to own as much as you can of those companies. So actually related to that point, we got a great question via email from one of our investors this week, which said, should I exercise my pro rata rights? To be quite honest, it depends, right? There's no clear-cut answer. Pro rata rights are a right, not an obligation. That is the minimum amount that you are entitled to invest in a follow-on financing. Things to remember, though, is that it's really important to lean on your winners. Okay, so this would be case number 1 in which you would want to exercise your pro rata rights. I would liken this to a game of poker where with each card, it reveals more information. And as you get more confident in your odds of success, you actually want to lean on your bet and put more money into the pot. So you might kind of open up with that initial ante, which is relatively small, but you want to be able to stick around the table long enough in order to see the odds turn in your favor. And then you really want to be putting as much money behind that as you can. So that's number 1 reason why you would exercise your pro rata rights. The second reason is to avoid being crushed. Even really good startups sometimes hit rough patches. And when those rough patches come, sometimes VC funds will lead follow-on rounds with pretty aggressive term sheets. And if you don't have the capital and the pro rata rights to participate in those follow-on rounds, then you could end up being diluted pretty substantially, and then you're not still holding your piece of this promising company. But important note is just the actual pro rata right amount. Okay, so you might find out, okay, here's how much my preemptive right is. That number isn't exactly relevant unless you're a VC fund that has a particular equity holding target where you know that your mandate and model requires that you own 20%. It doesn't really matter what that amount is. If you have the opportunity to, why not put in more than that amount, right? If you believe in the company and believe in its prospects and think that the odds have turned even more in your favor, why not invest more and buy up? Similarly, if there's situations where you want to protect yourself against some dilution, but not all of it, you can also invest less. So I would just tell people to not get hung up on the specific number that corresponds to their pro rata investment amount as kind of being the anchor number, because they might have an opportunity to invest more or less. Today's agenda is talking about convertible notes. We're going to, throughout the presentation, touch on the pros and cons of convertible notes, both from the investor and the entrepreneur's perspective. And we're going to cover all of the terms in a convertible note. At a very meta level, the goal of today's webinar is to really keep things simple. And the reason why that is relevant to the topic is because one of the primary reasons of doing convertible notes over equity rounds is the simplicity and the speed at which those rounds can get done. So we will hopefully be able to explain everything very clearly. So convertible notes is an investment that is structured as a loan, but which converts to equity if certain events occur. So obviously those events are predefined, and we'll get into that more. Generally, that event is a future financing. So why use a convertible loan? So from an entrepreneur's perspective, number one, it increases the speed to money. STM is something that I think Zach made up as
I did make that up.
An abbreviation. I like it. So it increases the speed to money, both because the negotiation process is shortened, because there aren't a lot of terms to hash out, and from a legal kind of cost and process standpoint, it's much simpler agreement to execute. The entrepreneur might use a convertible loan as a bridge to the next round. So let's say that they secured a Series A, and they're not quite ready to go out and do a Series B, and they think that if they hit some further milestones over the next few months, that they'll actually be able to dramatically increase their valuation and therefore reduce the dilution that they encounter in the next round. So they might say, well, let me do some sort of interim bridge financing, and a convertible loan is a great structure to be able to do that. Next would be increased flexibility with the size of the investment and the equity stake hold. So with a convertible loan, unlike with equity investments, where often a venture fund who's leading an equity round might have a particular equity target that they need to come away with post-financing, that is usually not the case with a convertible loan, and therefore they could take a smaller amount of money and sell less equity at that point in time. And lastly, which is another thing that entrepreneurs really favor about convertible loans, is that often there's no control provisions associated with them. Often they don't come along with board representation. And for those reasons, it's viewed as a very flexible form of financing that just gets them to that next stage where they're ready to do the equity round, which would then have control provisions and board representation tied to it. I will just say as one caveat, in many situations when we at OurCrowd use convertible loans, we still do negotiate for board representation. So that's something that is just a point of negotiation. So why would an investor use a convertible loan? Why have we done a number of these at OurCrowd? I think we've done at least probably at least 20 convertible loans just off the top of my head. So from the investor's perspective, it's also faster and easier and cheaper, but that's not really kind of an underlying investment motivation. The next reason is a better one from kind of a very real perspective, and I have a few anecdotes like this where it really enables securing of a deal. So let's say there's a really competitive deal dynamic. It's a hot company. There's a lot of capital chasing that round, and you have some sort of relationship with the founder or inside track. And if you can kind of guarantee faster execution of an investment and are willing to defer on the negotiation of the different terms and the valuation, that will allow you to actually secure yourself a seat at the table where you participate in that convertible loan and then convert into equity when that next equity round is done. And this is used as a very kind of strategic move by a lot of investors in order to get into very hot deals. Next is get some built-in upside. So there are economic advantages to doing a convertible loan as opposed to participating in an equity round. We'll touch on those a little bit later. And lastly, there is very, very full downside protection, which we'll again discuss later in greater depth. Use cases. So if you're an investor and this is a first investment, it displaces the valuation discussion onto a larger institutional entity. So this is something that we might not be a motivation for us to do a convertible loan, but as an individual angel, you might say to yourself, hey, I don't really know how to negotiate for the right terms, and I don't know how to price this company. Let's let the market determine what the company's worth, and that will be validated by a large institutional investor. So I'll just come in as a convert and let the institutional investor do the heavy lifting as far as the terms and the price. As a follow-on, so an investor might provide one of their portfolio companies with a convertible loan as a bridge to the next round. So that kind of relates to something we talked about from the entrepreneur's perspective, that by doing so, you give the company more runway to allow it to really create even more value before going out and doing its next round. So one of the things which is core to doing convertible notes is you really have to have faith. And what you have to have faith in is that the investor who's going to lead the next round, the equity round into which you're going to convert, is going to negotiate the rights and preferences that you'd want to see in an equity financing. Because eventually the rights and preferences that you're going to inherit are going to be the ones that they negotiate, because you're going to be converting into their class of stock. So it's important to know that you have to be comfortable with this level of uncertainty, but as you'll see soon, it's structured to compensate you for that uncertainty as well. So the first thing that's defined in a convertible note is the loan amount. How much money is going to be lent or invested by you? How much money is going to be lent or invested by others? If you remember all the way from lesson 1, it's important to understand how much money is coming into a company and at what price that money is coming in order to understand what the cap table will look like and what your ownership percentage will look like. So it's really key to understand the amount of money coming in. This is also important to make sure that the company's not being underfunded, because if the whole idea is for them to successfully hit milestones and be able to raise their next equity round, well, you want to know that they're actually raising enough money to get them there. And lastly is, what is the time frame for others to join? You don't want this to be a convertible note that's just hanging out for the next 6 months and people are putting in their money at a much later stage than you are and getting the same terms, so you want to be protected against that. The next key thing, which is a key term of any sort of debt instrument, is the maturity. Right? What is the term of the loan? Typically in convertible notes, it's a 12 to 24 month period. This is determined by a variety of factors, both in terms of what is the company's future financing plans, how much capital do you think is required now versus later, but it usually falls within the range of 12 to 24 months. Again, something that is a common feature of debt instruments is interest. So convertibles are loans, and therefore they have interest rates associated with them. And we'll get to an example of kind of interest rate math in a second. Then you have this notion of secured versus unsecured convertible notes. Secured convertible note actually has collateral backing it. So if you think about your mortgage on your home, so if you defaulted on that mortgage, the bank would be able to come and seize your home. Or in certain secured loans, the borrower will actually place a personal guarantee on that loan. So if you're taking a small business loan, for example, you might guarantee that loan with other assets that you have besides for the assets of that business. So same thing here, you've got secured and you've got unsecured loans. The vast majority of convertible notes that you'll see are unsecured, which means that at the end of the day, if the company defaults and becomes insolvent, then you're really just stuck with a claim against an insolvent company, and the likelihood of recovery isn't very high anyways. Prepayment. This is a very short and simple point, but an important one. The note may not be prepaid without the consent of the lender. So the motivation for the investor in doing a convertible note is to be purchasing equity. You want to be investing in this company because equity has, all of the significant upside associated with it, which is why we're all investing in early stage companies. If the founder had the ability to just come and say, oh, here, thanks for the loan, let me pay you back your money, you would not want that to happen because you're really in this for the equity and the upside. So interest, when you're talking about early stage companies, because they're not generating cash, and for the most part, they're not profitable, the interest is actually accruing rather than being paid out. So take this example. If you had 8% interest per year and you invested $1 million, and that $1 million converts to equity in exactly 1 year, so that would be the equivalent of having invested $1.08 million. So that interest accrues and is added to the principal when calculating the number of shares that you purchase in the equity round. So one other point to highlight is 2 different types of interest. Again, this is not unique to convertible notes. This is just a general kind of terms associated with debt instruments where you have simple versus compound interest. Simple interest just means that the interest that you earn in a particular period, that interest then does not itself earn interest in future periods. Whereas for compound interest, the interest actually does generate interest. And if you take our same example here, and if you look after 2 years, so simple interest would yield an investment amount of 1.16 million. So if we really just took the 0.08 for 2 years is how you get to the 0.16. Whereas in a case of compound interest, the 1.08 that you had at the end of year one, so that full 1.08 earn 8% interest in year two, which ends up resulting in a higher investment amount. So conversion is the moment when the magic happens and you move from being a debt holder to being an equity investor. And this is when you actually go ahead and know the class of stock that you are purchasing. You know the price at which it's being purchased, and you will no longer have any sort of debt claims over the company. So there are two types of conversion. There's automatic and there's voluntary conversion. They're exactly as they sound. Some conversions are forced and triggered by particular events. We'll discuss that in greater detail. And others are optional. When those trigger events do not occur, you still retain the option of converting to equity if you'd like to. So automatic conversion, I actually just grabbed language from a template term sheet in order to walk you through what automatic conversion looks like, because this is probably the most important term in one of these financing structures. So it reads as follows. Prior to the maturity date, upon receiving notice from the company that the company has raised more than X million in funds in which it has issued preferred shares, then the note will automatically convert all principal together with all accrued and unpaid interest under the note into the shares issued in such qualified financing. The conversion price will be a price per share equal to. Okay, so what we've done is we bolded here all of the key points that we want to focus on. So the first one is that in order to be defined as a qualified financing, the company has to have raised more than X million dollars, okay? How do you determine what that X million dollars is? Great question. Well, what you want to do is, if you remember when we talked about keeping the faith, so you want to ensure that the person who's going to be negotiating the terms of that round are an institutional investor who's going to be savvy enough to negotiate the right terms that you'd want. So often the threshold is set to such a high level that ensures that it's not going to be a round that are just led by angels that are perhaps less experienced or less sophisticated in negotiating for the right terms, but it's going to ensure that there's actually an institutional lead investor that knows how to negotiate the right way. But at the same time, you're not going to set that threshold too high because that's just not practical as far as the company's fundraising plans. The next important term is that it's going to be converting into preferred shares. This is important because you don't want common stock. So if for some reason the next equity round, even if they raise the right amount of money, if they're raising it and issuing common shares, you don't want to convert into those shares. And this touches on things we've discussed in lessons 1 and 2, why it's important to have preferred. Next thing, it's automatic. You don't have a say in the matter. It just happens when these conditions are met. And lastly, into the shares issued in such qualified financing. So you actually are purchasing that same class of stock. And if you, again, refer back to lesson 1 and 2, you'll understand what all those different types of rights and preferences of equity rounds are. And all of those would be defined when that equity round occurs. So now you know which shares you'll receive. You'll be receiving the same shares that the equity investor negotiates for in that round. But what are you paying for them? How do you know the price that you're going to be paying? So the conversion price is defined as follows. In many cases, I just, again, took a very standard template example, but there are a lot of variations on this. But this is a very common formulation of the conversion price term. The conversion price will be a price per share equal to the lower of A, Y% of the price paid in the qualified financing. Okay, so you get some sort of discount to the price per share in the next round. Or B, a price per share reflecting a company pre-money valuation of, X dollars. And that is what's known as a cap. So the price per share that you are going to pay, and it's important to understand this, is the lower of either of these two price per shares that are calculated as such. So let's drill down a little bit more into the discount. So the discount is the discount to the price per share paid in the next round. Typically, this discount is 10% to 30%. Most often, you see 20%. And there are certain variations that are important to be aware of. One is what I termed a time-triggered discount. So a company might say to you, listen, if we actually close the next equity round within 90 days, then you know that we are already in process with those equity investors at the time that you did the convertible loan anyways, so it doesn't really make sense that you would get a discount. So let's agree that there's no discount if the next round happens within 90 days, but if it's after 90 days, then you can go ahead and get the 20% discount. The next thing, which is a variation which is commonly used, is known as escalating discount, and that actually sets certain time thresholds for when the equity round occurs, and the discount actually goes up over time. Conversion price, and we're running a little bit behind schedule, so I'm going to pick up the pace a little bit. The conversion price, if it was a 20% discount, and if the next round they're buying stock at $1 per share, you then would be purchasing it at 80 cents a share. And we did some math here in order to illustrate how you actually then come away with more shares for a similar sized investment as the equity investor. Now, moving on to the cap. By the way, this is a picture of Donnie Foreman, who is one of our community managers here at OurCrowd, wearing an OurCrowd cap. I want to give Donnie a shout out for helping put together the slides. A conversion cap is saying that under no circumstances, okay, regardless of the valuation of the next round, will we be converting at a higher valuation than a certain, predetermined pre-money valuation. So if you wanted to think about kind of what is the break even between the discount and the cap, so let's say the example was a lower of 80% of the price per share, meaning a 20% discount, or a 20 million cap, okay? So where the break even would be at $25 million valuation, because anything less than a $25 million valuation in the next round, so you'd end up getting a 20% discount to that, because that would end up yielding a valuation of lower than the 20 million cap. But anything that's higher than a valuation of 25 million, you'd convert at the 20 million cap, which also, by the way, means necessarily that you're actually then in those situations getting a discount greater than 20%. So this is how the cap comes into play. The importance of a cap for investors, it's really important to protect the upside on a risk-adjusted basis. Listen, if I'm going ahead and I'm providing you with capital today, okay, and this also relates to aligning interests and protection versus tail risk, I'll just bundle them all together. If I'm giving you capital today, I'm taking much more risk than the equity investor who comes into the picture 6 months or 12 months or 18 months down the line. Not only that, you're actually using my capital in order to build the value in the company. So I want you to be going out and raising the next round at as high of a valuation as possible. I want our interests to be aligned. I want to be helping you. Okay, I don't want to be cheering for that to be a low price. So therefore, I need to make sure that if some crazy event happens and before doing the next round, you end up growing the valuation by 10, 20, 50x, then I'm not going to be just getting simply a 20% discount to that, but then I'm actually locked in, at maximum valuation. But at the same time, management is sensitive to where the cap is set because they don't want that to be an anchor when they go to negotiate the next round's valuation. So you end up finding a compromise. Non-qualified financing is, let's say that they do a next equity round that doesn't meet the criteria that we just discussed for qualified financing. So you're not forced to convert, but you can voluntarily convert or choose to stay outstanding as convertible debt. It's really important that the terms clearly state what occurs in the event that there's an M&A prior to conversion. Okay, you don't want them to simply go ahead and repay you because you're not in the business of being a lender. So what happens is there's a few different types of term sheets that I've seen as it relates to M&A. The first one is that you would get paid back, but you get paid back a multiple of your investment. So you get paid back 2 or 3x, for example. Next would be that you convert at a discount to the purchase price. So whatever the acquirer is paying, you get some sort of small upside, which is that discount. Or lastly, you actually define what a conversion price would be, and sometimes we'll make that the last round's post-money valuation. So you get any of the upside between that valuation and the M&A price. Okay, what happens at maturity? So let's say you didn't convert, all of a sudden you hit 12, 24 months out, and the loan matures. So again, term sheets can be written in different ways. The most common assumed event would be repayment, okay? And what repayment would mean is that the company now owes you back your loan plus the accrued interest. There are various issues with, and if the company is unable to repay, and if you demand repayment, so then you can actually send the company into insolvency. So because of that, there are certain issues with repayment terms in convertible loans that sometimes companies push back on, because entrepreneurs kind of view these as ticking time bombs, and it creates a lot of unnecessary pressure. And if the investor's unlikely to get repaid anyways, because for you, you'd rather them actually go out and raise another round than actually make them insolvent. So, sometimes people question the merits of actually having repayment built in. It is important, again, to note that they can never force you to accept repayment, but you would always have the option to convert at maturity if you wanted to. The other type would be that, hey, the loan matures, now there's automatic conversion. That automatic conversion is at a predetermined price. Likely that predetermined price won't be the valuation cap, because they were unsuccessful in being able to raise over the period of the loan. So maybe it'll be last round's valuation or something like that, but that's something that's negotiated, and that would just be an automatic conversion at that predetermined price. Okay, a few issues that people have with convertibles, which have really sparked a lot of debate, and I could talk about this for hours.
He literally could.
And it's really interesting. But if you remember lesson 2, when we talked about anti-dilution protection, and if you remember, we discussed that full ratchet anti-dilution protection is the most severe form of anti-dilution protection. By severe, I mean it's the most investor-friendly and company-unfriendly. Because what full ratchet means is that if there's a next round that's done at a lower price than your investment, you get fully reduced to the price per share of that new round. Now get this, if you really think it through, convertible loans have even more downside protection than full ratchet. Okay, so as onerous as full ratchet is viewed in equity term sheets, convertible loans actually provide even more downside, because if you end up paying, let's say the cap that you agreed on would work out to a $4 million valuation, okay? And they go and do the next round at a $2 million valuation. Not only are you actually lowered all the way to the $2 million valuation, but you still get your 20% discount. So you're getting even more than a full downward revision. So on the investor side, that's what makes convertible loans so attractive, but it's very important for entrepreneurs to pay attention to that. The next thing, and this is a very nuanced point, but it can result in more than a 1x liquidation preference. So if you remember lesson 1, when we talked about the importance of liquidation preferences, I will just very quickly touch on this. Let's say that you invest, again, with a $4 million cap, and the company then goes ahead and raises at a $12 million valuation. So you're going to be getting 3 times as many shares, okay, for your invested dollars as if you had been putting in that investment in this equity round. Now, the issue is, if they're giving you shares, let's say, of the Series A, and if that Series A has, for each share, a 1x liquidation preference, so now you actually have a liquidation preference on 3 times the amount that you actually invested, right, or that an investor would have gotten if they came into that round. And that can create a big issue for companies. So there's a couple of solutions. Sometimes they'll you'll get the discount shares issued to you as common stock. So the amount that you invested will be converted into preferred, but kind of the additional compensation that you get is given in common. Or what will happen is, when the equity round happens, different classes of preferred will be created in order to adjust the price per share to ensure that you're not getting more than that 1x liquidation preference. But it's something to look out for. And the last issue that people have with convertibles is that it has these features of debt, and particular interest rates and maturity. And it has those debt elements, even though the intention of all parties involved is for this to be an equity investment. So some people think that creates kind of misaligned incentives and unnecessary pressure. So what are some alternatives that have been proposed? We'll go through these very quickly. One would be priced convertible debt, okay? So as we just discussed, all of the pricing risk is really taken by the company, because you set a cap, and that's the ceiling, okay? But there's no floor. So if they go ahead and when we talked about one of the early motivations for entrepreneurs to do convertible loans, is because their hope is that when they then go and do their next round, the valuation will be even higher than the cap. But let's say that all of a sudden something happens in the market and things turn a little bit south and the valuations are lower. Okay, this convertible debt accomplishes the exact opposite goal of what they wanted to, because it's coming in at a low price. So what some people have proposed is saying, hey, keep all of the elements of the convertible debt where you're not negotiating any of the terms, and you're kind of leaving that for the future so it can still be a fast form of financing. But why not set a floor to go with the ceiling and actually define a price for the convertible loan? The next type, which has grown in popularity and I'd say is more popular than the price convertible debt that we just discussed, is what's known as a SAFE, a simple agreement for future equity. And as you saw in that TechCrunch article, Y Combinator, which is a famous Silicon Valley-based accelerator, has made the move from convertible notes to SAFEs. The key difference between SAFEs is that it takes the convertible note and it strips it of its debt features. So it doesn't have interest rates, it doesn't have maturity dates, but other than that, it's pretty much identical to the convertible note, but it's just very clear up front, hey, this is intended to be an equity investment, so let's just call it what it is, which is an equity investment where there is still can be a discount, there still can be a cap. We'll make sure that you get what MFN stands for in the center of the Venn diagram is most favored nation. So if someone else negotiates a convertible note after you with even better terms, you can go ahead and accept those terms. If there's an exit prior to conversion, you're taken care of. So it still gives you all of those things, but it just takes away the interest rate and the maturity date that are associated with the debt side. And that's it for our discussion on convertible notes. We'd really like to thank you for joining us for our term sheet series. We had a ton of fun doing this. We hope that you enjoyed it. We hope to be able to bring a lot more content like this to you. And with that, Zach, do you want to introduce the poll?
Sure. So you should see a poll in front of you right now. This was a 3-part series. We had, I think, over 1,000 people join us throughout the series. David, you've done a fantastic job in educating us. I learned a ton. I heard from a lot of you as well that this was valuable to you. We will send out a recording and slides to this presentation. We did go relatively quickly. It was a 30-minute session, but we thought this was the best format for you guys. So appreciate your feedback here. We're doing these educational events both for our existing investors to help them get smart, as well as for the greater community. So your feedback is very important to us. I'm Zach Miller and David Stark, both here from OurCrowd. Thanking you again, and we'll catch you again next time.
Thanks, Zach, for all your hard work and helping to organize this.
Good night, everybody.
Close the poll, you don't have people.